Welcome to our weekly Ask the Fund Manager series. The premise is simple. We put a fund manager on the spot and we ask them questions about current events and how these events impact on investment markets. We aim to keep it interesting and understandable and do this all in under 5 minutes. We hope you enjoy.
Productivity and the persistent lack of productivity growth has been one of the major challenges for developed markets in the 21st century, particularly within Europe. Increasingly, what we're seeing is that artificial intelligence, or AI, is being heralded as a potential solution to this. And you've got a set of global technology firms that are racing to change this trajectory through a wave of innovations, and investors have really been piling in on this trend, as we've all seen. The big question that we've got now is this investment justified, or are we repeating the mistakes of past tech bubbles like we saw at the beginning of the 21st century? To explore this, I'm joined by multi-asset portfolio manager Dean Cook. Dean, welcome. Good to see you.
Thanks, Luke. Good to see you too.
Right. So first question, what is productivity and why does it matter?
Sure. So in simple terms, labor productivity is output per hour of work. And you look at the growth of that by understanding any improvement. So if you can bake 10 cakes in an hour instead of 5, then you have become more productive, and it reflects the efficiency of your economy. And despite major technological advances, productivity growth has stalled in recent decades.
Yeah, that's always confused me, that we've seen these huge technological advancements, but actually we're seeing this kind of stagnating productivity growth at the same time, despite that tech adoption. So what would you say is behind this?
Yeah, it's a global issue, one that we've seen get slightly worse since the financial crisis. In places like the UK, we think that the complex web of challenges likely includes some mismeasurement risks. So we've had the advent of the smartphone, but not all of the benefits of that seem to be captured in economic data. High industrial energy costs, that's a problem facing Europe as well. Heavy regulation, which can hit smaller firms harder. Limited job mobility, some declines and stagnation in the manufacturing sector, and actually slowing international trade growth, which had previously been a tailwind for productivity.
Yeah, so that's a pretty complex list, and I'm sure it gets longer potentially than that if we had a bit more time. But I guess the question is, what could change this? What could change this trajectory?
There's plenty of views on this, as you can imagine, including plenty amongst the economist community. But AI is held up as a potential breakthrough technology that could unlock further efficiencies, automating routine tasks. Just imagine how kind of useful that would be for ourselves on a daily basis, and then boost economic growth as a result of that. We've seen some papers from Goldman Sachs. They've, amongst many, but they've estimated that generative AI could create $20 trillion in global economic value over coming decades, which is a massive number, with $8 trillion potentially flowing to US firms. So you can see why the investment in AI, chips and cloud infrastructure has surged as companies see the sort of prize at the end of the road.
Yeah, absolutely, and also investors have really backed this theme very strongly. But just in simple terms, what do these businesses actually do?
Sure. So if we were to really distill it down, you've got the AI model owners and builders. So they're the ones doing the legwork on that. You've got the companies providing chips that help to power the models, and then hyperscalers who deliver cloud infrastructure that allow their customers to access the models. And some companies do more than one of these, but it's a useful way of thinking about it. The leaders in these areas are highly profitable companies, but they're also investing heavily as well. So AI-related CapEx, so think about that as, say, long-term investment in physical infrastructure or developing models, has reached $200 to $300 billion since 2023 and could total $3 to $4 trillion by 2030. So some big numbers.
Yeah, and that leads really to the big question on investors' minds at the moment, which is, are we then in some kind of AI bubble?
Yeah, and you really left a difficult question for last. I guess one can look at the kind of the reality of it, and the latest earnings cycle of reporting. So the third quarter in the US has seen some very strong earnings numbers from these technology companies, particularly the AI beneficiaries, and that's not just revenues or the promise of future revenues. It's actual earnings, actual cash flows, and you can contrast that to the dot-com era, where a lot of the successes were based around the promises of future earnings and cash. So being able to see the actual cash is a big differentiator. It's also worthwhile bearing in mind that the thesis that fed the dot-com bubble was correct. So the fiber that was put into the ground has been incredibly useful at driving connectivity and innovation. But that doesn't mean that over the short term, share prices didn't get overcooked as part of the journey. So I think it's fair to say that whilst risks exist if expectations run ahead of reality, the long-term thesis is strong. If AI can help us solve some of our productivity problems, then the firms that supply the tools have the opportunity to generate a lot of revenue and cash flow off the back of that. So a bit like the internet, the potential there is huge. Profits are going to take time, and there'll be winners and losers for the investment community to identify.
That's a very strong and balanced answer. So thank you very much, Dean. And I'm certainly hoping that we see some notable productivity gains in the UK and further afield. I think that's going to be really beneficial for everyone. And it's going to be absolutely fascinating to see how this theme plays out. So we're going to wrap up there. Dean, thank you so much for your time and thoughts today. It's been really interesting. And we look forward to seeing you next week for another topic that's caught our eye. Thank you.
Thank you for listening. We hope you enjoyed this episode, and we hope you listen in again next week. Also, we love to get feedback and ideas for future episodes. You can use the link provided below to share your thoughts. Before you go, just some important information to be aware of. Unless otherwise stated, any opinions expressed are those of Aviva Investors. You should not be viewing this as an indication of any guarantee of return from an investment managed by Aviva Investors, nor as personal advice of any nature. Information contained herein has been obtained from sources believed to be reliable, but have not been independently verified by Aviva Investors and is not guaranteed to be accurate. Past performance is not a guide to the future. This material is not a recommendation to sell or purchase any investment. The value of any investment and any income from it may go up as well as down, and the investor may not get back the original amount invested. Nothing in this material, including any reference to specific securities, asset classes, and financial markets, is intended to or should be considered as advice or recommendations of any nature.